All right, so a few months ago, I did two videos on Canadian favorite telcos, BCE and Telus. I reviewed the quarters, told you what's going on, and then a lot of investors were asking me for a remake of that video looking at the latest quarterly earnings. Let's be honest, not much has changed since last fall, but now we have a little bit more information. We have the guidance for 2024, and we'll know if both companies' dividends are safe or not. So let's get started with BCE results. As you can see on this graph, the market didn't like that quarter at all. Actually, there was some good, some bad, and some ugly from this quarter. So we're going to jump from BCE and Telus this video to show you the difference between both telcos. Because when you look at both stock trajectory, you will notice that while they do pretty much follow the same lines, Telus is doing a little bit better in this beginning of the year, and we'll see why I prefer Telus over Bell in this video as well. Now, since I'm a positive guy, we're going to start with the positive things. So there are some good coming from BCE results, and those are highlighted at the bottom of this chart. That is a nice chart that BCE is providing on their website. You can find it for every single quarter. And as I told you, I wanted to see higher operating cash flow, lower capital expenditure, which would generate stronger cash flow. And this is exactly what we've seen this time. So for the quarter specifically, those are the numbers I was expecting. This is what I wanted as an investor. Full disclaimer, I do not have Bell in my portfolio, but if I wanted to make sure that the dividend would be safe, those are the information I would be looking at. Unfortunately, that was pretty much the only good news. As you can see, operating revenue were pretty flat. Net earnings were down double digit. Adjusted net earnings were positive. We're going to look at that as well. And then the net EPS was down double digit. So overall, definitely not a great quarter. And what was worse, actually, I think it was BCE guidance for this year. So for the full year of 2023, we got 2% revenue growth. Now next year we expect flat to up to 4%. So nothing necessarily to be really excited here. For the adjusted EPS, it was down 4% for the year. And then for the next year, well, shocker. Now we expect -2 to -7% for the EPS. So again, not really encouraging, but then you can tell, but Mike, what you told me to look at is the free cash flow, right? So operating cash flow minus CapEx gives you the free cash flow, but damn, what a bummer. Down by 3% all the way down to 11% in terms of expectation for 2024. So not much exciting news right here. We're going to talk about the dividend in a second because I would not categorize that as a good part. I would not categorize that as a bad part. Yeah, you guessed it. It is an ugly one. But now let's switch back to Telus for a second. So in terms of results for the year, the revenue and the earnings per share, it was better for the last quarter at Telus than it was at Bell. But what was really important again was the relationship for the three different cash flow metrics. As you can see, CapEx is down by 19%, operating cash flow is up by 17%, and free cash flow is up also by 83%. So again, telling me Telus is going towards the right direction because the narrative over the past 10 years was we're going to get into a lot of debt, we're going to massively invest in our network, expand our network, develop 5G technology, develop other business segment, and we're going to generate more cash flow. So we're pretty much at this part now. We want to see higher cash flow, and we also want to see expenses in CapEx to slow down a little bit. What I think made a big difference, though, is in the guidance for 2024. So while the results were pretty much the same between Bell and Telus, even though Telus was a slightly better, the guidance is definitely a lot better. So revenue growth, 2 to 4, so a little bit better. But what is even better, what is great, is the expected free cash flow. So last year we were at 1.8 billion. This year they expect to generate 2.3 billion in free cash flow, and with lower capex at 2.6. So now you can see that the free cash flow is getting bigger and bigger. It will cover the dividend for 2024, which should open the door to more dividend increase, but we're going to see that at the end. Before we get to the dividend, I wanted to come back to Bell's results because they are in a major restructuring phase where they're going to lay off people. We're talking about roughly 9% of all their workers, so it should be significant. At first, it's not good news for the employees, obviously, because they're losing their job. It's not necessarily good news because they will generate, the company will generate extra expenses for severance fees, but going down the road, they expect to save some money, which should be good. But overall, this is definitely not a time where Bell is telling us, well, you know what, we are a thriving business. Not exactly what we're seeing here. Now, the graph that you were looking for, and the answer to the question is the dividend is safe. So Bell just increased their dividend, but by 3%. And a lot of people, and I agree with them, the safest dividend is the dividend that just has been increased. This is a good saying. I kind of agree with that. But the problem with that is Bell usually increases dividend by 5%. So by going down to 3, it kind of sends the wrong signal. Kind of remind me as well at a company that started with 10% dividend growth rate for a few years and then drop it down to 3%. And that company is not in my portfolio anymore. Hello, Inbridge. But for Bell, it hasn't been in my portfolio, but that definitely do not convince me to move forward with this one. So far, I'm going to stick up with Telus, keep my eyes on the operating cash flow, the capex, and the free cash flow. Last quarter, they announced their second dividend increase of the year, which is typically what they do. So they increase their dividend twice a year by about 3% each time to average between 6 to 7% dividend growth rate every single year. So the next quarter, we're going to have a little bit more information about Telus dividend. So far, what we have seen in terms of cash flow metrics, it seems to be on the right way. Hopefully, we're going to have another good quarter next time, and then we're going to have that 3-point-something% dividend increase that will confirm that Telus balance sheet remains healthy, that management has a strong confidence in the business, and that we should expect another year with a double increase. As for Bell, I am disappointed. I think it's a red flag. It's not like panic mode right now. I would not run and sell this one, but I would monitor BCE very closely from that on, making sure that the metrics are improving based on the guidance. Do not hope that it will be a bit major improvement for 2024. So make sure that you follow your dividend stocks. It's not because a lot of people are using cell phones that this business is making a lot of money. Just have to think about what happened to AT&T in the States. After several years of struggling, they eventually cut off their dividends. So nothing is safe. You always have to do your due diligence and to monitor your companies every single quarter. All right, that's enough for this video. Let me know if you hold Telus or Bell, and if you're worried about the dividend at this time, give me a thumbs up. Don't forget to subscribe to the channel to not miss our next video next Thursday. And in the meantime, don't forget to stay invested.